Hello.
Hello, how's it going?
How are you?
I am
It's
doing
going.
well.
It's been a long week. I am gonna eat pasta. I hope you don't mind.
Oh, I don't care.
But okay, I was like, you can explain all the things first, and then I'm gonna eat and take notes. So that's gonna work out for me.
How is your whole portfolio doing this week?
Honestly, I haven't touched it. They gave me a new client at work, and on just like a lot of work. So sadly, it has not been touched, which makes me really sad because I really like to have time for both things. And my job sometimes doesn't respect that. They're like, you work at a tech company and you're a high performer, so go do what high performers do, aka have more clients than you need. And you're like, cool, thank you, thank you. I will just do
But
that.
the advantage to being busy and having a job and selling premium is time is always working in your favor. So whether
Mm-hmm.
or not you're looking at it, you're making money as time passes with your short options against your stock. So I think it's
Correct.
trading right around 27 bucks. This I've got
Yes.
it as a screenshot here today, and you've got
Thank you.
14 days left in your
Mm-hmm.
contract.
Mm-hmm.
So this is normally I do the monthlies, and I look to manage them at the 21-day mark, usually on a Friday. Depends on what the market's doing. If you want to roll out and up, now is the time to do it. The stock price is right at your current strike.
Yes.
So if you are still bullish, now would be the time to give yourself more of an opportunity to take in more credit and have the ability to make more money on plug. If you
So
still want to get out of the stock, I wouldn't do anything. I would just leave it.
okay. So rolling out would entail me rebuying a
Buying it
buy
back
contract, yeah, and rebuying my contract back and then selling a new one.
further out in time, further away from
Yeah.
the money. You don't have to
Yes.
go further away from the money, but and if you're not gonna
But
go further away from the money, I probably wouldn't do anything because there's still $100 in extrinsic value left in your contract.
so do I keep and I keep the difference of the contract that I sold and what I'm gonna have to sell my new contract for, correct?
Yes.
Or no,
Yeah,
what I'm
yeah.
gonna have to buy back my
I know what you
contract
meant.
for.
Yes. So the price that you have to buy it back for and the credit that you get for selling the new one, the credit needs to be more than what you're buying it back for. There was another option that you could have looked at today if you really aggressively, it's not as good right now,
Mm-hmm.
but if you really aggressively wanted to get out of the stock and still give yourself even more room to make money, today when the stock was closer to like I think 27.50, you could have bought back your contract and sold the 25 strike out in November. And that actually gives you much, much more downside protection. So the 25 strike in November was in the money, but it was trading at $4 at one point today. So effectively,
Oh
it would be
wow.
the equivalent
So
of
even
getting rid of
you
your stock for $29. And it gives you significantly more downside protection if the stock doesn't perform. So when you get a rally like that, if you still are trying to get out of the stock, you can actually roll down into the money, and it kind of is a way to lock in some of your gains and still give you room to make more money. If you roll out and down, it's it's an exit strategy for sure. You're not looking to make a lot more money, but you are giving yourself way more downside protection. So $400 of downside protection.
Right, so can we like pause and break that one down? So what we would have done is basically rebought my shares, and then we're looking to
No,
buy and well sell another contract at a later point in time in November.
yeah, you would have bought back your 27 and then in
Yes.
November sold the 25 because
Yes. And
because the 25 is so far in the money, you would have taken in all of that intrinsic value plus some extrinsic value.
yes, because the stock is currently trading at 27. So that's why you have
Correct.
both of intrinsic and extrinsic value.
Yep. So
Okay, cool.
it's
So
it's not really it's more
for
bearish. It's more bearish. It's giving yourself a lot of downside protection.
so yes, and for everyone watching, what we're basically saying is that if you're selling a call for a later point in time, in this case in November, at a lower price than what it's currently trading at, you would in exchange get $400 for selling it at 25 versus 27 than what it's selling at. Is that a correct way to say it?
Yeah. And at the time, I think the stock was trading at 27, almost 50. So effectively, you're getting 250 of intrinsic value or just pure downside protection that consists of stock price and another 150 of extrinsic value or cushion, which would have net credited you, I think, about $50 or so. So you could have made an additional 50 on top of your your current call that
Price.
you sold. Ultimately, when you exited the stock, you would have ended up selling it for 25, but the credit would have compensated for the difference in price.
Yes. Okay, that makes sense. So in this scenario, I basically have two options. I'm either going to continue holding plug and roll out my shares, or I'm going to let it ride out. And if I want to keep the stock, then I should just roll them out, aka buy back my contract.
Well,
And then
not necessarily. I mean, you can just do nothing. There's nothing wrong with doing nothing. You still have $100
but
left that you can make. What's that?
wouldn't it get called away?
If it's above 27, but I mean, it's right at 27 now. The chances of it being above 27 in 14 days is 50-50. So there's a 50% chance you'll lose the stock, and there's a 50% chance you'll keep it because it's currently trading right at
Mm.
that price.
So if I want to take the risk, I could do nothing and see what happens.
Yeah. If you
But if
really,
I want to be safer,
yeah, the only reason I would manage now is if you really wanted to keep the stock and you were bullish, or you absolutely wanted to get out of it and you wanted to protect your downside. If 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 you're kind of indifferent and you want to see how it plays out and you're okay keeping it or you're okay losing it, either way, I wouldn't do a darn thing. I just let it ride. You still have $100 that you can make off of that call in the next 14 days.
okay. Can we also break down why the price, like, you're not making any money as the price of the contract goes up or down based on the volatility of the stock itself, correct? Right. The price of that contract changes, but like you yourself are not going to make more or less money because you already locked in your set price that you're willing to get
You have a
when you first.
maximum. Yes, you do have a maximum
Yes.
amount that you can make.
So
You
even though
can,
in the platform it's
go ahead.
like changing value, the contract itself,
Mhm.
the contract to you personally is not going to change in value of how much credit you're going to be receiving
Yes
in
and no.
exchange for.
The biggest, the only thing that you really need to watch out for is you can, the higher the stock moves, the faster you will realize that profit. So as it moves through your strike, you're going to have less and less that you can make on that call because it'll squeeze all of the extrinsic value out of it and replace it with intrinsic value. So say the stock,
Because the stock price is moving
yeah,
up.
yeah, if the stock were trading at 30 right now, you'd probably only have maybe like, 15 bucks left to make out of it. So to take 14 days of additional risk to make $15 doesn't really make sense in my mind. I would close the entire position at that point and exit because at that point your risk reward isn't really worth it. So no, you're not really making any more, but the price movement affects the speed at which you achieve your maximum profit.
But like to date, have I really collected any money on it?
Yeah, that money's in your account. So that money sits in your account as
Oh,
soon as you sell the call.
sorry.
Yeah.
Oh,
You can use that
okay, I
money. You
didn't
can
know.
take that money right out of your account. The same day that you sell the call, you can then take that money and go buy, I don't know, whatever people buy. I don't buy things.
Dinner,
I buy
ice cream,
coffee. Yeah.
same.
But yeah, no, as soon as you sell that call, that's your money and it's guaranteed. Nobody can take that away from you. What I like to do is I will
Oh,
take a stock position that I like to sell calls on. I'll sell a call and then I'll turn around and buy a few more shares of the same stock. So instead of having
mm-hmm,
100, I'll have 105. And then as time goes by,
mm-hmm,
you've got 120. And eventually you'll get to
mm-hmm.
where you've got 200 and those extra 100 shares didn't cost you a dime. It's faster to
Okay,
achieve that if you already have, a couple hundred shares, then you can build up to an extra 100 faster. But you can definitely, if it's a long-term hold, I have stocks that I've sold calls on for 6 months to a year straight, or longer than that. I've held American Airlines ever since the crash. So
no,
whenever the
really?
market crashed, yeah, I bought into American Airlines and I've been selling calls on that. And I got blown out to the upside, meaning if I didn't manage it, I would have lost my shares. So I rolled them out to like 6 months ago. I rolled my contracts out like 6 months up to the 20 strike. And that's around
Mm,
where it's currently trading. But it gave me enough extrinsic value because of the time that I gave up to roll it out that I was able to keep the shares. And a month or two ago, I was able to roll another one and take in another couple $100.
this is
So you,
starting to make more
yeah, you always got options. I mean, you can do whatever you
sense.
want. That's the
Unintended.
coolest. Yeah, that's the coolest thing about options is like you can do whatever you want with them. It's all about your opinion that you're trying to express, and you can make the options express any opinion that you want, whether it's, bearish, bullish, or kind of neutral. You
Can't
can do
cover it.
anything.
I think that's the part I wasn't really clicking for me earlier because at first I thought when you did covered calls, you basically just like you had the contract and there wasn't really any way to get out of it. And so, in my opinion, if you wanted to hold long term, I'm like, okay, but what if your shares do get called away, which isn't something that you would necessarily want, especially for tax purposes in some regard? Get called away, which isn't something that you would necessarily want, especially for tax purposes in some regard. Right. And then let's say it's getting closer to the time when they would get called away. If you can buy back your contract, that makes it almost safer because then you can decide, okay, I'll buy back the contract. I still got some premium for it, but now I'm basically going to resell another covered
You
call.
can always buy back your contract. Now, provided you have the capital to do that.
Right.
You can always buy back your contract. And then what's going to happen if you have a deep in the money call, that contract is going to be made up of pure intrinsic value. So when you buy it back, then you now own the stock, which is trading at the price of whatever it's trading at. So it replaces that purchase and you own the stock instead. So you can always buy back your contract and then you'll own the stock at that price. You'll just miss out on the move from the point of your short strike that you sold to where you buy it back at. It's like you take a gap in the stock price from that point to however high it went.
But I'm still, if I'm buying back the contract, I'm not buying, or I am buying. Am I
So
buying the number of shares if I already own them and I sold the covered call? No,
no,
right?
so
You've already bought your
you
shares.
already have your
One.
shares. So in your case, you sold it at 27. So you took in $150. So
Yeah.
that's 28.50 is your maximum sale price of that stock.
Yeah.
28.50 is your exit. Say it's trading at 35. That means that you've missed out on $6.50 or $650 in profit. It also means that to buy back that 27, if it's trading at 35 on expiration, it's going to cost you
Mm.
$800. You still keep the 150, so 150 less that 800, or 800 less that 150 is 650, and that chunk, the stock has a value of 3,500. So that that $800 purchase that you're making to buy back that contract is going to be replaced with that value appreciation in the stock plus the
Mm-hmm.
credit that you took in. So you're in the same
Mm-hmm.
exact spot if you buy back the call as you would be if you sold your shares at 28.50 or
Yes. Yeah, that makes
27
sense.
plus the short call. So you're in the same spot. The only difference is now you're taking on more downside risk.
Can you elaborate on why you're
Because now you
taking?
own a stock that was worth $3,500 and you didn't appreciate the last $650 of it. So you didn't appreciate that gain of $650. So if the stock were to drop now, you're starting at a higher cost basis without having gone through the appreciation process. And if the stock drops back down to where it started, you're going to realize losses as if you had bought it up there in the 35s. Whereas had you just bought the stock and it went to 35, you'd have $800 of profit. And if it dropped back down to 30, you'd still be sitting on profit. Whereas if you, in that situation where you bought your
Right, and
call
that's
back,
as if you're buying it at the peak and then
yeah, it's basically
now
because
you're losing.
you're skipping out on that chunk of appreciation. Whatever you buy your call back for, if it's deep in the money on expiration, if you buy it back, you're missing out on that chunk of appreciation. So you are taking on more upside risk. And you would need the
Mm,
capital in order to buy back that $800 call in your account because you're missing out on that appreciation. And it's easier to see more risk in that regard because it costs you that much more money to
more.
maintain that position, even though you're not losing money because you're replacing your
It
money with
costs more.
an asset.
Yeah, it still costs you more to then reacquire the asset in some way,
So
which feels in a way worse to you, even though the math technically.
yeah, the math works out, but it's definitely more risk.
What about in a case where the value of the stock relatively stays the same? Like in this case, like plug, let's say, doesn't really go higher than 27.50.
You sell calls all day long.
Okay.
I keep rolling,
And then
rolling into
to buy back
perpetuity.
it won't really cost me more than
If
what
the
my premium was.
if the stock is at if you sold at 27 and the stock's at like 27.50, then you're going to be able to buy the contract back for 50 cents and sell a future one for probably another 150. So you'll roll it out at that point and
Oh,
you'll take in another $100.
cool.
Yeah. That's the cool that's it. Options are amazing. Cover calls are the best, most simple strategy that any person that already has stock or wants to get long stock, um, on average, if you look at like statistically, whether or not if you were to just buy the S&P 500 or buy the S&P 500 and sell calls against it, you make more money doing the covered calls. There's tons of studies out there that show over time you end up making more money because you're
Well, yeah,
constantly adding a
um,
second element.
because you can do covered calls every month, and so you have 12 chances to make money, whereas like you're relying on the S&P 500 to make you 12% a year.
Yeah, and it also smooths out the volatility of your portfolio as well because you have two sides to every. So you're reducing your delta by the amount. So like if you have 100 stock, that's 100 delta. But when you sell a 30 delta call against it, you've reduced your volatility of your portfolio by 30% or somewhere around there, 20 to 30%.
Sorry. Is that because you are basically lowering your average cost per like share acquired as a result in a way?
Yes, it has
Or
a muting effect on your downside and a muting effect on your upside. That's why it lowers the
okay.
volatility. So any swing is going to be muted, whether it's to the upside or to the downside. The only actual outperformance that you'll achieve is if you get an inside move, which statistically 68 point what 2% of the time you're going to get an inside move. So the vast
Mhm.
majority of the time stocks don't do what Plug did a year ago. Like 90% of the time, you don't see that kind of behavior within a stock. And it's really exciting when that happens. But even if you were selling calls on Plug back when it was trading at $25, $30 a share, you would have had a lot of opportunity to roll out and take in large amounts of credit because of the violent moves increases premium. But after that move came back down, you would have missed out on the opportunity to sell at the peak. But that's only if you have the skill, knowledge, and foresight to sell at the peak, which most people don't. So that's why, even if you're getting blown out to the upside, sometimes in a covered call, it's not the end of the world. You roll out, you try and take your strikeout as high as you can, take in more credit. But overall, I think it's beneficial. The only times when it would really come back to bite you in the butt is in a stock like Tesla or Apple that just massively outperformed and never came back. So those would have been
Where you
missed opportunities.
continuously have to rebuy
Yeah,
and pay more to then reacquire
yeah,
the contract.
yeah.
But if something's trading relatively flat, especially like we've been having in the market, then it's better, especially for options, because you won't have to pay like rebuy your contract at a higher premium.
For the last 6 to 12 months, really, covered calls would have been a massive benefit to your portfolio. The only time they would have been a detriment to your portfolio would have been directly after the crash for those 6 months when the market just went, well, not even six, it was more like 2 or 3 months where the market went haywire. And even
Mm-hmm.
during that time, that was the majority of my strategies were covered calls. And the volatility was so great that you were able to get large amounts of premium and still stay relatively far away from the stock price. So you were able to make really good profits even with a cover call strategy during that time period as well.
Right, because the volatility, the more volatility, the higher the premiums, and thereby, even if you have some, then you can collect and then roll out regardless. So you can like
Yeah.
wait for a big upswing and then collect a higher premium and sell that call then.
And
And
that's,
then as it gets closer, then you can rebuy it and then do the same thing, wait for an upswing and resell a covered call. Is that?
yeah, especially if it's a stock that you are comfortable holding. Like
Yeah.
my biggest my biggest issue is I don't like having stock without a call sold against it at any time. And that works to my detriment because I'll miss out on large up moves that I could have taken a good amount of appreciation and then sold a call. But I typically just sell a call right away. I like the reduction in portfolio volatility more than I like the potential opportunity to make an outsized move in profit.
I mean, that makes sense because even if you, especially if it's something long term, then like you still want to keep it even if it makes an outsized move.
Yeah, and it's
Right.
not always going to work out that you can keep it 100% of the time. I had Disney called away from me and I kind of got a little pissed at myself because I wanted to keep Disney, but I wasn't able to. It just the move was too great after earnings. Like I kept it all the way from down into the 70s during the crash, all the way up into like the 120s. But after that, it just exploded, and I just said, forget it. I'm not. I would have had to roll it out like a year, and even then, I probably would have still been pretty far in the money. Um,
Mm.
and I would have had to roll it out another year once that one expired. So I was like, do I really want to keep it or do I want to use this capital somewhere else? Because during that time, you're limited as to what your capital is doing for you. If you're rolling out
Correct.
really
You
far,
can only you basically are tied only to the premium
yep,
because your shares are locked in.
yes, you can only
Or
make the extrinsic value. So it's really a waste of capital at a certain point to continue to do that, to roll out and up. So it's better to just be called away and move on or sell puts.
Mhm.
So the covered call, once you understand the covered call, which it sounds like you do very well, once you understand the covered call, you understand all options because options are just two different contracts. One's the exact opposite of the other, and two different sides to those contracts, buyer or seller. And once you understand the covered call, you can go back to what you know about the covered call and extrapolate to understand any option strategy. If you use the basics that you know with the call, how it works when you sell it, and you also know how it works when you buy it. So you can use that to figure out exactly what it looks like on the put side as well, because it's just the opposite.
Right. And so let's say we want to roll out crypto weatherman. You just short everything. We love that. Um, so in the instance where I want to keep my plug shares and I want to roll them out, I'm going to have to buy a put, right? Is that the correct terminology?
If you want to keep your plug shares and you want to roll them out,
Yes. Because like I'm not selling a call because I've already done that. So now that I need to buy back that call,
then you
do
would
I
sell another
buy back the
call.
call?
No, you would just either buy back the call and sell another one or just buy back the call if you want to keep your
Okay.
shares. Yes. So
Okay.
we were supposed to be covering definitions. we
Yeah,
haven't
it's
gotten
okay.
to.
This was but then in the case, so then the put, so the call is if I feel like it would be going on the upside.
So when you're selling a call, what are you doing?
You are collecting a premium to
But
allow someone to buy shares at a certain price,
so you
even if
have
the
an
stock.
obligation.
Yes.
Your obligation is, that was a question.
To sell your shares.
Yes.
Sorry.
Yes.
To sell your shares at a specific price,
So
regardless if it goes high.
exactly. So when you
Okay.
sell a put, it's the exact opposite. You have an obligation, but it's the exact opposite. Your obligation is to buy shares, regardless if it goes lower.
Mm.
So selling a put is a bullish strategy. Selling a call is a bearish strategy. When you mix it with shares, it becomes a more neutral to bullish because when you have 100 shares, your shares are always going to take the majority of your position, meaning they're going to have more of an impact on your overall position than the contract because the contract is dynamic in
Right.
nature. It changes. It doesn't have as much premium associated with it than the entire value of 100 shares. So it's always going to, your contract will always take a second fiddle. So because of that, it's still a bullish strategy when you have 100 shares and you sell a call, but it's less bullish.
Is
Call,
it if you're selling a put, would you say that that can technically still be bullish because what you're saying is you're willing to buy at that
it's
price, which means
100%
that
bullish.
that's when. Okay.
I don't ever buy, well, I shouldn't say I don't ever. I rarely buy shares. If I want to get long something, I sell puts. So, for
Right,
example,
because
I
you're
sold a put in plug today.
oh,
I sold the 20, I sold two puts in plug. I sold puts in a couple accounts in plug today. Um, I sold the 20 and I sold the 22 and a half out in November. Because I closed my position out on this last rally. I had a covered call that I put on when we started this, and mine was more conservative. I sold the 25. I think I bought the shares at like 26 and sold the 25. So I gave myself more downside protection, but I also didn't have as much upside that I could make. And I made about 50% of what I could make, so I closed out the trade. And today I sold out in November because we're at that 21 day mark where I start looking at November contracts. Um, and yeah, I'm still relatively bullish in there. I don't mind owning the stock at 20 or 22 and a half, so I sold those contracts. And if the stock
do
doesn't get,
you
do I what?
so in that scenario, would you think about it as like, oh, I can use the premium that I collected from selling the covered call to then pay for my sell put? Okay.
Um, Covered
Because
calls.
you still have to pay
Well,
for
when
premium.
you
Now you're the
sell
one premium, right?
when you sell a put, there's two different types of accounts. There's a cash secured account and there's a margin account. So depending on whether it's a cash secured account like an IRA, they're going to be cash secured. If it's a margin account, then you're going to get, so gets into, it's an important thing to understand about how options work. Margin accounts give you capital efficiency. So so think of it this way. When you sell a put, you're guaranteeing to buy the stock at X price. In this case, plug, I sold the put, I collected say $50 for selling the put. I'm guaranteeing to buy it at 20, collected 50, so I need $1,950 if it's a cash account to sell that put.
Oh, so in a cash secured, you would need to actually have that
Because
amount
yeah,
in
the
your
broker is going to
portfolio.
want that money in case you ever have to buy the shares. They're going to want that as collateral to say, all right, you're willing to buy the shares at 20 plus $50 that you take in, so that's 1950. So it's going to cost you $1,950 to sell this put. In a margin account, what they do is the broker looks at the price of the stock, the volatility of the stock, the deemed risk within the stock, and then they come up with a collateral amount that is a realistic loss should a bad thing happen in that stock. So if things go to shit and everything goes bad, they're going to come up with a dollar amount that is realistically a likely amount that you might be looking at losing if things go badly. It's
So that's
90,
what they would for you to require to have on your account.
yes. So for
So
example,
the
if I
way we think
wanted to
about it
sell,
is it, can we think about it in the sense that like cash secured is like you absolutely need to have 100% of the funds to cover what you would need to buy, whereas margin is more of a dynamic
yes, it's
price
dynamic
option.
and it's leverage. It's leverage because they're not
Okay.
requiring you to put up the entire amount of risk. It's 100% by definition leverage. And that's where the capital efficiency comes in. So for me, in my TD Ameritrade account, for me to sell this 20 put, I'm only collecting $42. It doesn't make sense for me to spend $1,950 to collect $42. That's not a good return on investment. So in a cash account, that's probably not a great return on investment. But in my margin account, the broker is only going to require me to put up about $350 to sell that. So $42 on 350, that's over a 10% return on capital. That's a much
And
better return.
if for whatever reason the like we get to the end of the contract and you are not obligated to buy those shares because it didn't hit the strike price. You would get back that leverage.
Once you close
Yes.
out, yes, once you close
Okay.
out the position, your buying power, they don't call it like cost, they don't call it like leverage, or they call it a buying power reduction. So at any given time, you have a buying power in your account that's not necessarily the equity of your account, but it's how much the broker is allowing you to use to trade options at any given time. And it will fluctuate in a margin account every day because as the stocks in your portfolio move around and they get closer to the strike price, it's going to affect how much those contracts are worth, and it's going to affect how much the broker is going
Go.
to require in capital. So I'll give you an example. The same stock, if I wanted to sell the 25 strike instead of the 20, I'm $5 closer to the money. I would be taking in $165 instead of 40, but the capital that's required for me to do that is closer to $900. So I'm taking in almost four times as much capital, or over four times as much of a credit, and the buying power is a little over twice as much because the broker deems the likelihood of me taking a loss on selling a 25 put is substantially higher than the likelihood of me taking a loss on a 20 put. And the likelihood of me taking whatever the loss may be is much, like, the further away from the price that you get, the less capital the broker is going to require. But
Right, because
as the
technically
trade
the
is,
chance
yeah,
of
the
it
chances
getting
of
to
it.
that price is lower. Okay.
But as the trade moves against you in real time in your account, so say tomorrow this stock drops $4, the broker's going to say, okay, there, Skippy, you now need to, they're going to increase the requirement for your account to maintain that position. So instead
So
of
then,
then holding 400, they might be holding 600 because the stock has moved and my risk has changed.
so in that scenario, the brokerage would basically be freezing parts of your account, like the
Yeah,
funds that you
yeah.
would have available
Your
in your
buying
account.
power
Yeah.
will change. It will increase and decrease every day based off of your overall risk of your portfolio.
Mm.
And that's so when you're trading options in a margin account and you're selling premium, it's very important that you maintain a large buffer. So
Right,
my
because
one
it
account,
can.
I have about 60% of my capital available in buying power for situations where my buying power increases or the market moves in one direction really, really fast. Your buying power can change drastically. So it's very, very important that you don't over leverage yourself because it's easy to forget that you're using leverage when the broker's only requiring a certain amount. You get reminded of it real quick, fast, and in a hurry when your buying power doubles or triples overnight because the market just crashed. And then you're being forced to look at
In
closing
that scenario,
positions.
the broker will say like, "Hey, like this is moving really fast and it's getting closer
They don't say a
to."
darn thing. They just
Ah,
you see your buying
they
power go
freeze.
down and down and down. Yeah, you just see your buying power get smaller and smaller and smaller, and then eventually it'll turn red, and that's not good.
Uh,
It's
that
not,
makes sense. Okay,
it
I
doesn't mean
get
you
it.
have to instantly close out your trades if it goes red. I've had it go red before. It's a skill. It is a really, like, managing a portfolio that consists entirely of short options is definitely a skill, and it takes a lot of getting used to understand how market moves are going to affect your portfolio because there's really no way to comprehend risk until you've seen it go through. So as a general rule of thumb, if you're trading in a margin account and you're selling premium, you want to stay about 40% or less of your overall capital in your account, you want to have that free, is a good rule of thumb. Now, I over leverage in smaller accounts. It's a lot harder to do that. The smaller your account is, the harder it is to stay at that 40% level. And sometimes you do have to get a little bit above that. And I've done it in the past, and I've gotten my face ripped off in the past where I've had to close positions out because I just didn't have the capital to maintain some of the positions that I wanted to keep on, but I just didn't have the capital because the moves were so violent that it was game over.
Yeah, that makes sense because if the stock, let's say, I don't know, hits 15, then they're going to require you to have way more buying power and they'll take that away from you to be able to utilize. And so if that's happening across multiple like trades, then your
It
entire
can
account is now
it
red.
can get
Okay.
it can expand very quickly. So it's critical to avoid being put, and you put yourself in scenarios really, and it usually stems from having too much risk on. And most people don't understand risk, especially from the short side. When you're selling options, most people don't understand the amount of risk that they're undertaking at any given time. It's usually significantly more because one put, when you really think about it, one put in a stock like Apple is $15,000 of risk selling one put.
Right. So,
But the
and
broker is
that's
only going to
why
require
I,
1,200 bucks.
well, now, but like if the stock starts moving, then they might
Then it goes
require
up
more
and up
because
and
like
up.
it's moving. We're getting nervous. We need you to have more capital on hand for you to actually collect this premium because
Yeah,
we're getting nervous. And if that keeps
yeah,
getting
it's all
bigger and bigger,
algo generated. The
right?
only time I think it's not algo generated is in stocks like GameStop and AMC, and stuff like that. My position in GameStop is a wonderful case study of what not to do. Um, I was short a lot of calls in there, and I didn't have the stock to cover the calls. And when I initially started, because I've been trading GameStop for a long time, like years before it exploded. And when it exploded, it was probably like a two or three thousand dollar position as far as the capital required to trade it. And I had been trading it, and it was no big deal. But when it exploded, it went from a $2,000 or $3,000 position to a $60,000 position in a matter of like 2 or 3 days. So the capital requirements are, it's not it's not like linear. It's what is that
But
term?
in
It's
that case,
exponential. So the more contracts that you
yeah,
have on, you're taking exponentially more risk. And it's what's called outlier risk or tail risk. And that's one of the most frequent phrases that we say is trade small and often. And what they mean when they say trade small is not only the buying power in your account, but the amount of contracts that you have on it at a given time.
right, because then it can easily just start getting very out of hand. But in
Yeah.
that position, regardless of the fact that your margin would need to be 60K for GameStop, you would still only be collecting that small amount of premium for selling the put. Even though now
I had
you're
calls.
broke.
I sold
Oh, you
calls.
had okay, okay.
So that's when you agree to sell the stock. I agreed to sell the stock at 20 and 30. And so that means if I
Uh,
don't own the stock, I have to go out and buy it at 400 and turn around and sell it
yeah,
to
but then
somebody
sell
at
it.
20 and 30.
Yeah, 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 yeah.
Yeah,
But so
not
in that
good.
sense, would that be a naked covered call?
It's just naked call.
Naked
It's
call.
selling a
Okay,
naked
okay.
call. Yeah,
Because you don't actually own the shares.
correct. So in my
Okay.
situation, I bought shares as the stock went up. I bought more and more shares to the point where I was in a covered call positions. And I
Uh,
rolled out my calls as well so I could get them to a higher price so they were above the cost of my shares. So it worked out
Okay,
in
that
the
makes sense.
end, but only because I'd been trading for a while and I knew how to reduce risk as it was happening. If it wasn't for that, what it would have exploded in my face, and it would have been it would have been a $400,000 loss. Yeah.
That's when you just cry in a corner and you're like,
Well,
never again.
that's when you appreciate understanding risk and understanding size and the importance of staying small.
Right. I mean, to me,
Yeah.
even just one contract is the fact that it's 100 shares is kind of a lot.
I still only
Only because
trade
I don't,
one contract in most stocks. If the stock is above $100 or $150, I'm only trading one contract most of the time.
right. Yeah, that makes sense to me. And obviously, I'm dealing with like smaller figures, but yeah, because then 100, I'm like, okay, like that's a sizable amount. So, like, one, let me start there, and then we'll go one at a time and like figure it out.
Well, the cool thing about options is you can get smaller than one contract of 100 shares. You can do spreads, and that lets you define your risk to whatever amount you want. So a
Is that
spread,
the one where you buy on one on each side and you take home the difference?
yeah. So say you had plug. Well, let's not say you have plug. You do have plug. Um, so let's look at the, I don't know if you have a computer in front of you or not, but if you look at the November expiration, right now, you can sell the 30 strike call for $157. You can buy the 35 strike call for about $67. So that gives you, the difference is about 90 bucks or
90.
92 bucks. Yeah. So you're cutting out a chunk from 30 to 35, and you're collecting $90 out of that $5 chunk. So your risk is very easy to figure out. Your risk is $410.
Wait,
You're
how'd you get 410?
$90 off the 500. It's $5 wide. So you're buying the right to buy the shares at 35, and you're selling the right to someone else to buy them from you at 30. So you're only
Yes.
exposed. So you have to get rid of, or you have to sell shares at 30, but you have an insurance policy that lets you buy them at 35 should everything go terrible. So if it goes to a million, you can still buy them for 35 and turn around and sell them for 30. So you're only losing $500, but you get to keep the credit of 90, so you're really only losing $410. That's your risk. That's all a spread is. So the broker is only going to require you to put up $410 to put that trade on because that's all you can lose in that trade. And that's how you can take out whatever chunk exposure you want in any particular stock and still express whatever opinion you want by combining two. It's called a vertical spread. There's 4 different ways you can put on a vertical spread. If you're bullish, you can buy a call spread or you can sell a put spread. If you're bearish, you do the opposite. You sell the call spread or you
I get it.
buy the
So
put
in
spread.
either scenario, you're kind of like, let's say you're selling a covered call. In both scenarios, technically, you'd be happy, right? Because, well,
Well, if you own the shares, so in this case, if you own the shares, you could still sell this spread against your shares. You're not going to get the same capital relief, meaning you won't do it for free. I think the broker is still going to require you to put that 410 up. But what you're doing is you're reducing your upside um, chunk of exposure to $410. So if the stock does rally, you own the shares, and you sell a spread instead of selling a naked call, and it goes, say, to 80, well, then you've only missed
Uh-huh.
out on $410 of that move, and you still appreciate the rest of that move up to $80. So it would be like you only,
Why? Wouldn't I get called away with my 30?
if you get called away with your 30, you still own the 35, and it's now trading at 80. So you have the right to buy it at 35.
Uh,
You owned the stock already, so you lost your stock that you had, but now you own the contract that gives you the right to buy it at 35. So you're still only missing out on that portion of the move that was from 30 to 35, less the credit that you already took in. So if you're
okay.
really concerned about a stock that you think has the potential to explode, but you also want to reduce your upside risk in it or your downside risk in it, you can do a spread against your stock instead of selling a pure naked call. And then you're only just
Mm,
taking a chunk of that exposure and giving that up, and still leaving yourself room for the stock to run should it do that. But you can do that
okay, that.
without the stock at all, and just say you're bullish and plug. So I'm bullish and plug, but I don't necessarily want to risk $2,600. I think the stock's going to go up over the next, 2 or 3 months. You could sell the 25 put and buy the 20. You're taking a $500 chunk to the downside, saying I'm willing to buy the stock at 25, but just in case things go terribly, terribly wrong, I want an insurance policy at 20, where then I have the right to sell the shares at 20. So if I'm forced to buy it at 25, I've got the right to sell it back out at 20 if it goes to 10. So I don't have to appreciate that
Mm,
loss.
that's kind of cool.
Yeah, you can make the widths of those spreads however wide you want to get any type of exposure at whatever level of risk you're comfortable with. So if you only wanted to take, say you only wanted to take, now you can't do it in some expiration cycles won't have dollar wide strikes. So like the November contract that's currently out, the monthly in November doesn't have dollar wide strikes, they're $5 wide. But if you go back 1 week to the weeklies, they usually have much more. They're not quite as liquid, but they have a lot more strike options. So you could go, say, $2 wide. Say you wanted to sell the 25 and buy the 23. Let's see here. If you went $2 wide on that, that's $200 of risk, and you'd collect $57 for taking that risk. So you're risking three to make one, or a little less than three to make one. The most you can lose is 140, $143. You're still expressing the opinion. So the return on capital for spreads is significantly better than naked options. But because you're paying a premium on the other side, so like when you sell a naked option, you collect 100% of that as credit. But when you buy a spread, you're paying out another portion of that you're collecting as credit, and you're paying that to someone else to give you an insurance policy. And because of that, your overall credit that you're taking in is smaller than selling a naked option. And that means that your break even point, or the point at which you start to lose money, is going to be closer to the stock price. And that will always put you at a lower percentage of being profitable. The probability of being successful in the trade is always lower in a spread than selling the naked contract. The risk is higher for the naked contract, but the probability of being successful is also higher.
Mm,
Does
mm,
that make sense? Because,
kind of.
okay, so if we look at selling the 25, if you just sell the 25 naked, then you're taking in, say you're taking in a buck 25. That puts your break even at 23.75. So the chances
Yeah.
of the stock getting to 23.75 is less than if you sell a spread, because if you sell a spread, you're taking $65 of the credit that you're taking in, the 125, turning around and using it to buy protection, and that puts your credit that you're taking in only at $50. So that means that the stock price only has to reach $50 below the 25 strike now for you to start taking losses.
Oh, that okay.
You know what I
I
mean?
think that
So the
yeah.
only reason that a spread is always going to be a lesser probability than a naked option is because of the amount of credit that you're taking in overall at your short strike. And it's always reduced because when you buy a spread, you always have to pay for the long option of the spread. And that
Okay.
reduces your break even point by the amount that you pay for the spread or for the long option or the protection.
Okay. Hmm.
Is it all
That
making sense, or is it kind of still?
yeah. So then, okay, let me ask a question. Also, hi, fellow investors. Would you then be combining this with like technical analysis?
I don't do that a lot, but some people do.
Okay,
Um,
because like for a put, for example, if let's say like you're looking at a weekly chart and you're seeing, let's say, a dead cat bounce, and so like okay, you're can give or take, let's say technical analysis goes well, it's like oh yeah, it's gonna keep going down. You would then sell put to
if you thought it
be
was
able
going
to
to,
buy like to buy shares at a much lower price, thinking that it would go down there based on technical analysis.
well, if you think it's going to go down based on technical analysis, I would be selling a call because a put is a bullish strategy. I would only sell a put if I thought it was going to bounce.
Uh, in a scenario where you don't own any shares of said stock,
Correct. I
so
would
you
only
would
sell a
still sell.
put if I thought it was going to bounce because you make 100% of your credit when you sell a put when the stock doesn't reach that price.
Okay, that makes sense.
So it's bullish. Just like when you sell a call, it's
Okay,
bearish.
okay, that makes sense.
So I use technical analysis in the sense that I'll look for support on, I'll look for large areas of support over like a 6 month or a year chart, sometimes even a 3 year. And I'll look back for support if I'm going to sell a put and say, okay, it's got support at this level. I'm comfortable selling a put at or below that level. I'll use it in that sense. But more important than technical analysis, I think, is the amount of volatility in the stock, because that directly translates to how much you're getting paid to take on the risk. So if it's elevated in relation to where it historically has been, then that is more important in my opinion. Because when you think about it, the risk is the same or near the same, but you're getting paid more to take the risk in periods of higher volatility
Well,
than you are in lower volatility.
okay, but if we go back to the dead cat bounce, I guess then yes, you would want to sell the call, but to the commenter's point, he's like, oh, I would buy the dead cat. You would also want to do that.
If you were trying to buy the dip, yes, you would sell a put. I would sell a put. If I were trying to buy the dip and I thought there was support and I thought it was going to rally, but remember, that's a bullish strategy. If you thought it were going to continue to go down, then I don't think you would buy the dip. You only buy the dip because you think it's coming back up, right?
Right.
Because if
But
you
I
buy the
guess if
dip and it
you
keeps
like
going
for
down and
example
you
if
think, what's that?
but if you for example it's like if you saw the first arm of a dead cat bounce and you knew it was going to have another leg down, then like in some scenario you might want to have like show a level of resistance and then put the put around that so that if it hits that then you would be able to buy it at that level. But I guess No, because at that point it would be at that level anyway, so you wouldn't want to pay for the premium to buy it at that level.
Yeah, you always want your options to expire worthless. The best, you never want your option. I mean, it's not the end of the world if you get assigned shares, but the best case scenario is always that you want your options to expire worthless. When you sell a put, you should be comfortable owning the shares at that price. You shouldn't sell a put at a price where you're not comfortable owning the shares. Um,
Right. Yeah, that
but
makes
you
sense.
never want to have to buy the shares because the capital required to buy shares is significantly more than the capital required to sell the put.
Yes.
So, I mean, in some circumstances, I do take shares. Not very often. More often than not, I'll just roll my call or roll my put. I'll roll it to the next cycle, take in more credit, give myself more downside protection. And just like I do with the call, I'll roll my put down too. I just did that today with several different companies. I did it in EWZ, I did it in FXI, I did it in
Um,
um, Viacom, I did it in a bunch of
okay, we have
stocks today.
what is your take on leaps? Also, bounce bounce. I didn't mean to buy a dead cat. No, no one does. But
Um,
what is your take on leaps?
Leaps are the only way, in my opinion, that you can get realistic long exposure with options without feeling like you're taking on massive amounts of risk. I like leaps for that purpose. So, like, if you want to buy a call in something that you think over the next few years is going to go up, I think leaps are a great option for that. The only thing that I would say is when I buy leaps, and I do, I buy them deep in the money. I want a stock replacement. And the reason for buying them deep in the money, like 70 or 80 delta, is I sell premium against them. So I'll buy them 500 days out, and in the nearer dated cycles, say a month out, I'll sell calls against those contracts. Because just like stock, where it doesn't cost you anything to sell calls against stock because you already own the shares, when you buy a leap, you can do the same thing and sell calls against the leap, and it doesn't cost you anything because you have the long exposure through the leap. So you can
Uh,
do, it's called a poor man's covered call, just like with stock, but they call it poor man's because the capital required to maintain a leap or a longer dated option is less than the capital required to buy the stock usually. So they call it a poor man's covered call. And it's the same exact thing. You buy a deep in the money call, it acts as synthetic stock, and then you can sell calls against that every month to collect premium and reduce the cost of that call.
oh,
Yeah, you're
right,
opening
because
Pandora's box here.
I can see why options have so many options. Um, can I just like restate that? So what we're saying is like you would basically buy a super long cover,
You'd buy a
super
deep
long
in the money call,
call. Okay.
but a
Which
long
basically
dated.
will act as a share replacement strategy,
Yes.
which is why you can then sell
Yeah, because for
premiums
the
again.
next 2 years, you have the option to. I was looking at doing this in BABA today. Now, I didn't do it because the volatility is so high in there right now. It's not a great idea typically. I like the price in there now, but I don't like the volatility. And when you're buying an option, especially buying uh, a leap like that, they're really expensive in periods of high volatility. And the volatility in BABA right now is crazy. So I like the strategy and I want to do it, but I just am not. I don't like the price. Like I was looking at the 100 calls, 800 days out. There were $7,000 for them for one contract. But if you're buying the 100 strike and you're paying $7,000 for it, that puts you at a break-even point of $170 per share. So really, if you think that the stock is going to be over $170 in 3 years from now. It's not a terrible price. It's just more expensive than I wanted to pay, and you're paying for a lot of volatility. So with it trading at 150 or 145, you're paying $2,500, right? 25,
Yeah,
yeah,
yeah, yeah. Yeah.
in extrinsic value. Now you can sell
So
against it, and that reduces
yeah,
it.
so in that case, you would want to have low volatility for leaps, but continue to have high volatility for covered calls because then the premium that you'll collect there is going to be higher.
Yeah, it works out that they kind of balance each other out a little bit. It's just in periods of lower volatility, you can you can get the trade on usually for a lot cheaper. Um,
Mm.
the opportunity doesn't change a whole lot. It's just a lot cheaper to get the trade on. Because when you're selling that front month against your long dated option,
Uh-huh.
you are collecting more because of the volatility in that front month as well. So you're getting
Oh,
paid
okay.
more for
Well,
selling the front month because volatility is still high. Um, it was too large of a position for me to put on with any size, and I already have a long position on in there, so I didn't want to double down with a long position, having a crappy long position on already. So
I
I didn't
mean,
do it,
with
but I looked at it.
Alibaba, that's risky given the fact that China is just going haywire
They're
lately. I
committing
don't know if we.
financial suicide lately. I don't know what's going on with China. Like, I don't know what. Seems like they're
I don't
trying to
even want
kill
to
their
know.
market.
Well, maybe.
I
Honestly,
no,
like,
I'm
who
absolutely
knows?
100% serious. I'm not joking. I think
I.
Didi, you remember Didi, the rideshare company?
Mhm. Yeah, they have to get taken down.
They came out and within a week they had their app removed
Yeah.
from the App Store. Education companies in China went to not for
Yep.
profit. Uh, what's his
Well,
face?
because of
Alibaba's
their new
CEO.
strategy to basically redistribute wealth in
Yeah,
China, which.
Alibaba, their
Yeah.
CEO disappeared for 2 months. Real estate, their real estate debt crisis that they have going on right now.
Oh
Um,
yeah, the Lehman Brothers, whatever, something with an S,
there,
I
I
think.
mean, it's just been one thing after another. Luck and Coffee. Um, there's like three other things that I can't think of off the top of my head, but it seems like it's at this point. I feel like you have to almost be foolish to think that it's not intentional. I just don't understand what the purpose of it is.
Hmm.
So
I mean,
I still like
unclear.
it.
Maybe they think they want us to think they're weak, and then they're gonna come out with something very different from left field. That would
My
be my
theory is
my.
I think that they're intentionally driving the price of all their stocks down to get so that they can buy them. I think they're intentionally crashing their own market so that they can make a
So they
shit ton of money on the way back up.
the redditors haven't blown up the market yet. That's super fair. I love it.
I don't really know what's going on, but I do think it's intentional, and I think that it's either a an attempted attack on the United States market structure and the confidence thereof, but it's not having that impact. If you look at the overall
Mhm.
markets, it's had the opposite impact. It's been a
Yeah,
benefit because money has left the Chinese sector and flowed
the U.S.,
into the U.S. So it's
which
not
makes sense.
had that impact if that's what they were trying to do, but
Hmm.
I don't know. I don't know. But I still think as far as risk reward, when you look at the price of like the S&Ps, the Nasdaq, the Dow, when you look at those and you say to yourself, do I as far as risk reward when I'm buying something, what has more potential for upside growth at these price levels? I like China.
Oh yes, Evergrande. The
Evergrande. Yeah, that's
thank
the real estate one. Yeah.
Yeah, yeah. They're. I don't know why, but the media keeps calling it the Lehman Brothers of China, which is like,
Yeah, so I
um,
don't know. I'm long China right now. Um, I'm long FXI, I'm long Baba, I'm long Baidu, I'm long Didi, I'm long IQ, I'm long um, JD. I think that's about it. But I'm recently long all of those things. I didn't take them through this crash. I just bought them like last week. And I've
Hmm.
been slowly legging into more of China. But I mean, I could be 100% wrong. I
I
just
mean,
when I look
who
at risk
knows?
reward, I see more potential reward for taking the same amount of risk as opposed to buying the S&Ps. I like FXI right now better than S&Ps simply because of price.
Okay. Yeah, see, I feel like Neo's like the only,
Oh, I'm long Neo too.
yeah, Neo's the only one where I'm like, I will, give up my dislike for that sector because of the way that they rule politically and how much influence they have. Just for that one. All the other ones, I'm kind of like, ah, especially
I'm
after
not.
what they did to Hollywood. That one kind of
Yeah, I
surprised
lost
me.
a good amount when the whole that was the worst of all of it was the
Yeah.
education companies. Um, the education companies was brutal. It was 70% in one day. Um, a lot of people lost a lot of money that day. Um, but I'm relatively small as far as the amount of contracts that I've got sold in all of those products. So it's not like when I say I'm long China, it's not like I've got 20% of my portfolio in China. It's smaller than that. But I do think the risk reward is too, for me, it's too overstated at this point to pass it up.
Hmm. What about certain sectors? Are you more like in certain sectors versus others, or not necessarily, or is it just price dependent?
I'm in airlines because volatility's been good in them for the last 2 years. Um, and they're actually relatively stable. So I like airlines. I've liked them ever since Buffett sold. When he was saying he was getting out, I was like, all right, I'm in. And I'm like, you're the dude that said buy when everybody's selling. We'd be fools not to. Um, so I've liked airlines for the last 2 years. Um, I just recently got into Las Vegas Sands ever since that down move that they had when they got destroyed, along with the whole that coincided with the China thing as well.
Hmm.
So I probably actually have correlation risk with China in that trade, but I am long Las Vegas Sands as well. And for a while, I liked casinos and like entertainment type companies, hotels, entertainment, but I'm not as much into them. I think Las Vegas Sands is really the only one that I got on. I like for real estate, I like to trade Zillow. Um, I love Zillow as a company. I've used them as a landlord. I've used them as a buyer of property. Um, I like trading Plug, and Neo has also been a uh, a good trade as well. Um, the China
Yeah.
stocks, I think they are a good opportunity. They're really fat with premium right now. Space has been another excellent trade for me. That one has kind of died off here as of late, but yeah, a couple of
And
other smaller things, but
how often do you take into account like the fundamentals of the actual company versus just whether or not you
about
want to raise? Because, like, for example, someone made
never.
a good comment. Airlines have razor thin margins, which is super true, and like honestly, like very hard for them to be profitable, especially given times of like adjusting number of flights and cancellations and things like that. Is that something that you take into account or not as much?
No, not at all.
Okay.
So I'm
So it's just about
selling.
not the
It's
will
about
make sense.
price. It's about price, probabilities, and volatility, and return on capital. So the fundamentals of the company, if I cared about that, I would have never got long American Airlines because it's a terrible
Right.
company, but it's been an amazing long position for the last 2 years. especially after the large move, it's been a great covered call position as well. So the volatility stays elevated in there, I'll stay in there. When the volatility goes away, I'll move on to something else. But I don't care about fundamentals.
But so someone had a good question because they're just like, this is not investing then, and I guess technically this is just trading, not
No, I'm not.
investing.
I'm not an investor. I'm a trader.
Okay. Okay, that makes sense, right? Because if you were investing, you would have bought American Airlines, want to hold it long, and if you wanted to, you could sell covered calls against it. But as a trader, you can even do a leap and then do that for American Airlines from a price perspective, regardless of how you feel about the company.
Now, I still do have shares, but some of it comes down to the type of account. So, like with the IRA account, I don't mind holding shares in an IRA account in companies, even like American Airlines. As long as the volatility is there, I feel like I'm being compensated enough for the risk of holding those shares, even if the fundamentals aren't good, as long as there's volatility.
Huh.
So,
Interesting.
DraftKings is another one, and like my IRA, long bias, but that's in the form of a poor man's covered call, what we just talked about, where I have a leap and then I sell upfront calls against that leap. Um, ASO is another one, which is it's a,
What's that?
it's like Dick
Okay, that makes sense.
Dick's.
I think I personally, I don't even, yeah, like who owns Exporting Goods?
No, I'm saying it's like Dick's Sporting Goods. It's a sporting goods
Okay.
store. It's a lot smaller, but I used to live in Texas, and they had them down there in Texas, and I like them better than Dick's. They're just more affordable. They're a little bit more down to earth than Dick's. Dick's is kind of like, I've never liked Dick's as a store. It's just not like the everyday man store. It's kind of geared more towards the upper middle class, um, just because of the
I mean,
prices and the
yes.
brands. Yeah. So I mean, it's that's just a matter of preference for me. But I saw the market cap of this store, and knowing the quality of the store and the amount of business that they do, and it's almost like the Walmart version of Dick's, if
Oh,
that makes
okay.
sense.
Mm-hmm.
Like
Yep, it
so
does.
so and not only that, the volatility in there is amazing. The premiums that I was collecting in there and I'm still collecting were very, very um, large in comparison to the price of the stock. So that I like that. Trying to think of what else I've got
So,
going on in like
I also had
IRA
a good
type
question.
account.
They're like, the numbers say you should go long, but the underlying is garbage. Where do you think it'll go? Isn't that the point? Because then you wouldn't actually hit against the covered call, so thereby you could keep your premium and not have to sell your shares away.
I, I'm not sure I understood the question. What do you mean the numbers say that you should go? What does that mean?
Uh, I guess if I'm interpreting Echo's question, he's saying the numbers say you should go long, probably the premium that you would collect on the contract, right? And so, like, it's a very profitable trade for you to make, but the underlying numbers of the company itself are garbage. Where do you think it'll go?
To
So,
if
like, let's say
well,
Rivian went
in
long,
order,
the numbers to trade it were seemed very profitable to you, but the underlying fundamentals were trash.
I usually use price as more of a metric than I do like the fundamentals. Meaning, if I see that something appears to be oversold, then I'll go long. Um, if I think it's overbought, if it's at an extreme to one side or the other, I'll use that more than I will fundamentals. I don't look at any fundamentals ever,
Oh,
ever.
interesting. Hmm.
So it's all about the amount of money I can take in against the risk that I'm taking. And the juicier the volatility. And you can do that on a long term basis. And when it stops working, you move on to the next thing. So, like when the risk is not being offset by the reward from selling that premium against whatever asset that you're owning, then it's time to move on. You just close out the trade and you find a different stock. So it's not that I like American Airlines and I want the company to take over the world. I could care less what they do. Like I think they're
I
tired.
really hope not. They're pretty terrible.
Yeah, so I don't care about the company. I don't care about the fundamentals. I don't care about any of that. I think the price is relatively fair where it is. It's at the not the lower end of its range, but it's coming down off of its highs, and it's coming back into an area where it has a little bit of support. So I'm still okay being long shares it because I'm collecting, $150 against a $2,000 investment every, 45 days. That's like what? That's
Mm.
almost 10%. That's 7.5% every 45 days.
Okay, and we have another question of if you're not interested in fundamentals, do you trade earnings?
Oh yeah. Oh yeah. I traded Nike today. It was a beautiful trade. Put it on last night before the market closed, about 5 minutes before the close. Took it off this morning about 5 minutes after the close or open. I just sold premium there, a strangle.
Can you elaborate on that?
So people trade earnings from the short premium side, meaning they sell premium going into an earnings announcement because an earnings announcement is a binary move where anticipation builds up into the earnings announcement and then the news
Yeah.
comes out and all of the anticipation comes out because the move is then over with and the premium being based off volatility collapses. And when you sell the move, i.e., sell the expectation of the move, which is priced into the premium, so you know what the expectation is, you can look at the option prices and tell what the market thinks that stock is going to move. And it's even built into the option chains. It'll tell you what the expected move is right in the option chain. So you can sell premium and you're basically betting that the stock is not going to move outside of the expected move. It's going to be within the expected move, and 68% of the time it is. Sometimes it isn't. So you can sell directly at the expected move if you're bearish or bullish. Sometimes I'll just sell one side. If I don't have an opinion, but there's still good volatility in there, I usually will just sell a strangle, meaning I don't care what the stock does. I just don't want it to have a large overstated move. And then the next
Uh,
day, because the news is out, the volatility comes in, and as long as you don't have a massive move, you buy your contracts back for less than what you sold them for. And you can make anywhere from, on a decent earnings trade, you're making 20 to 30% of the credit that you're selling in one day. On a really good earnings trade, you're making 75 to 90%. And it's just a matter of putting it on before the market close and then taking it off the next morning. It's basically like a 45-day
mm.
contract or a 30-day contract wrapped up into one night. And usually you sell
Yeah.
the the weekly
So,
that
okay,
expires
let me
right
see if
then.
I can repeat this back because that's how I learned. So, what we're doing is we're basically like, uh, what's that phrase where it's like you buy the rumor, sell the news, right? Right? That's
Yeah,
basically
yeah.
what we're doing here is like we know that going into earnings, there's a ton of anticipation, there's a lot of hype going in for earnings. Whether or not they're good or bad, it honestly doesn't predict whether or not the impact of that is going to be higher or lower, right? Because we've seen companies have strong earnings, but shares fall down because people are selling the news once the earnings already come out the price might go down. So in this scenario, you're doing it the day before, you're buying or selling a premium that will have a high premium because you're going into earnings. And then the next day, once you already have the news come out, or once they have come out later that evening, the day prior, the contract you can buy it back at a later time and you basically pick up the spread.
The difference, yeah.
Yeah.
Um,
Yeah.
it's a completely binary trade. So it means You're right or you're wrong. Things go well or they go bad. You're in, you're out. Very rarely should you take an earnings trade and fight it to try and make your money back. It's better to just cut your losses and move on if you don't have a profitable trade. Um, Sometimes I break my own rules and I'll fight it for months, and I'll be in a trade that started as an earnings trade with a 1 day expiration to go, and then I'm in it for 3 months down the road trying to make my money back. So, I mean,
We don't
we
like
all
that.
yeah, we all break our own rules, but I mean, I've had trades that have gone thousands of dollars against me on earnings trades, and I have made my money all the way back in them. So, I mean, there's no absolute right way to do it, but as a general rule of thumb, it's just a binary play for a crush in volatility. Because when you're selling volatility, that's
Yeah.
always what you're looking for is volatility to come out. And it's an
Oh,
expedited version of that. But yeah, no, exactly how you explained it.
okay, cool. Um, am I gonna do it full time? Probably not. I unfortunately don't have enough time to dedicate towards this right now, even though I would like to. Um, my job just likes to keep me busy, which is kind of annoying. But maybe in a perfect world, if I take like an extended vacation, I give trading a go, like
Well, just keep
probably if it
building
goes
your
well.
account up over time, and then someday when you retire, you can do it full time.
I mean, maybe before I retire,
Yeah,
even that would be
before you
better.
retire.
Yeah,
Whatever.
I don't know. I want to retire when I'm like 80. That
I
seems
I
so.
do it be I do it because I love it. So it's like, yeah, you make money and that's great. But I do it because I really enjoy it. And if you don't really, really enjoy it, then I couldn't imagine doing it to the extent that I do it. It would be just like work. It would not be fun. But I do it because I love it.
I mean, it. What I find interesting about the market is that it, and this is a very lame like cop out, but I'm sure so many people say it, but it keeps moving. So like, there's always different things that are coming out that impact specific companies that you may have, and like, especially for companies that I would like to own. It's like that keeps me interested in learning about them. Whereas like there are certain companies I would never buy because like I just fundamentally don't agree with the company or don't like their business model, or I think the business model is not going to exist in 10 years. So I just like completely leave those chunks out of the market out. Or if I don't understand the market, like oil, anything oil related and gas, I'm like, well, natural gas maybe, but like oil, oof, gosh, just like hurts my soul so hard. Won't buy that. But
Did you
like
see
tech, I understand very well. So I'm like, okay, that I can understand the differences between like a trade desk versus a Google versus an Amazon.
That's a big, if you want to do covered calls, understanding the story of a stock and understanding the company is of great value to a covered call strategy. A covered call strategy is a long-term bullish strategy. You need stocks that are going to appreciate in value to make money consistently in a covered call strategy. Over time, you need stocks that are going to appreciate. So it is a perfect coupling with that style of investing. Buying companies that you like, that you don't mind owning for the long term, and then collecting income against those assets that you own. It's just like renting out a house. It's like buying a house and renting it to someone else.
Yeah.
You're buying a company and you're renting someone the option to buy it from you at a higher price. If it goes there, great. If not, great. But you like the company, so who cares if it goes there? You're going to make that money regardless.
Yeah. Right.
So it's a good coupling with that. I don't do a lot of that. That's not really my style of trading, but options, there's so many people that use them in 1,000 different ways. Some people use them just as hedges. They just want to protect a part of their portfolio against loss. That's cool. Some people use them as YOLO plays where they want to get rich. That's cool. If you can make that work, good for you. But like I mean, they're so versatile.
That you blow up your account and then you cry. Most
Pretty
people.
much. I mean, that's what I honestly think the majority of people that buy options at the end of the day, unless they're very skilled and talented in what they do, it's a zero sum game. Like it's not even a zero sum game. It's a losing game because when you buy an
Well,
option, you always have less than a 50% chance of being successful. Always.
Yeah, that makes sense.
Because you have time working against you. You're paying for time. You're paying for extrinsic value, and statistically, you always have less than a 50% chance because statistically, time will always pass, and you will always, that extrinsic value will always be zero at expiration. Now, you can make money, and you
Yeah.
can make a lot of money if you get the right move, but over time, on average, unless you're great at picking the right stocks and you have a lot of skill and know exactly what you're doing, I think it's a losing game because you're always, it's like going into a casino and playing a game where you have a 48% chance of losing and of winning and a 52% chance of losing. And you do that over time, you're always going to lose because the law
Like
of large
someone
numbers
asked,
doesn't lie.
what about deep in the money options that have no extrinsic value and aren't affected by theta?
Well, there are very few that have no extrinsic value. There are some that have very little extrinsic value, and they are a better option because they're deep in the money and they typically people that buy them buy like leaps like I was describing earlier, and the market does have a upward drift to it. So I think you're much better off if you're going to buy premium to buy longer dated options and buy in the money options. You're just setting yourself up for a better, more time to be right, give yourself positive drift within the market, and you have much less theta decay.
Hmm.
And you can get to a point where you have no theta decay if you can get to a theta neutral position, meaning it's not working against you and it's not really working for you if you sell upfront contracts against your negative theta. So
Okay, you kind of lost me, but I think Echo is following, so we're
the time
good.
decay. So basically you're buying time decay that's working against you, but you can sell time decay to work in your favor against that contract. The poor man's covered call, what we just talked about.
Uh, oh, so I
So
mean, so ultimately, what you just end up doing is just selling and then buying back your own calls, or vice versa, most of the
no,
time.
you're buying one that's deep in the money and you're selling it out of the money. So you're buying one that expires like 2 years from now, and then in a month from now, you're selling one that's out of the money or above the stock price. So for BABA, for
Uh,
example, I was looking at buying the 100 that expires in 3 years or 2.5 years and selling the 160 that expires in a month. So there's a 60-point
Okay,
spread.
okay, so it's almost like saying you're trying to, so you sell a covered call like 2 years, but in between that time, you're also selling
You're
calls
collecting
within
money.
it.
Yes, yes. You're selling
Yeah.
you're
Okay.
selling calls against it to collect money to neutralize the extrinsic value that you're purchasing.
Wait, but the first thing that you bought was that a covered call too? No.
The first the 100 call is, it's not covered, it's just a call. It's a naked call, but you're buying it instead of selling it. And you're buying it deep in the money and with a lot of time. And because there's a lot of time, you don't have a lot of theta decay or time decay. Every day there's very little amount of time decay that comes out of the option because the amount of time that's
So
left in the contract is so great.
okay, so let me see if I understand. So what you're saying is you're buying a call for 2 years from now to say, okay, I'm willing to buy shares 2 years from now at a particular price that is relatively similar to what the price of the stock is currently trading at. In
Usually it's
between that,
usually it's below the current price if you're buying it in the
okay,
money.
below
But
the
yeah,
current price of what the stock is trading at. But again, you're working with a 2 year time frame. However, within that 2 year time frame, you're basically selling calls against that same contract and trying to
Yes.
build money basically to offset the long term contract that you have bought.
Yes.
Okay,
Yep.
I think I got. Does that make sense to people?
Makes sense
The
to
Gen
me.
Z. Okay, but you've been doing this for a long time. I'm still learning. Um, the Gen Z portfolio is much easier 50% in Tesla and 50% in Bitcoin. Amen.
It's true. Hey, I just did a TikTok today about a crypto. So Tasty Trade has a new crypto futures product that they're coming out with. It's an index and it has about 15 or so different companies along with the spot price of Bitcoin that it tracks. So it tracks Bitcoin price is about, I think, 7% of the index. And then you've got companies like Riot, Mara, PayPal, what else? What is that one?
AMD?
Micro, AMD, um, uh, Taiwan Semiconductor, NVIDIA. I can't remember them all, but that was a good chunk of them. And so it's about 15, maybe 20 stocks that all have from 5 to 7% weighting within it, but it's designed to track exposure to crypto. Um, and it's a futures product, so it's leveraged, and it's a relatively small contract. So one contract is only going to cost about, I think, I don't know that they have the exact amount, but it'll probably be somewhere between $500 and $1,000, and it'll give you exposure to about $3,000 of notional value. So it's like trading a $3,000 chunk of crypto exposure for 500 bucks, and you can get long it or you can short it, and you don't have to go to some exchange that you've never heard of before, that's out of some country that you've never heard of before, that you don't
What
know
are
if
you
they're
talking
gonna.
about? But Finance US just completely like is not taking my money as of this
Yeah.
morning.
Well, that's
Um,
I think there's a lot of risk that people don't appreciate in those smaller crypto brokers, and people are starting to realize it when you have an entire brokerage or firm that just up and disappears. That's real risk. and and it makes me very uncomfortable. So having a broker like Tasty, being able to trade crypto on a broker like that has a reputation, that is regulated in the United States, I like that.
I
But
mean,
yeah,
I would like that to balance my portfolio, but I personally would also rather own the coins themselves.
yeah, well, and futures are not really designed for like long-term exposure. They're more designed to be used as a hedge. So like if you have, say you have an account and you've got $20,000 of Bitcoin sitting in an account. Well, with five of these contracts, you can effectively hedge your entire position for 2,500 bucks. In the event that you think we're going to have a prolonged period of a down move, that's a nice hedge where you'll make money on your hedge, and then you can take it off whenever you're comfortable. It's a great tool for other things as well. It's Futures are more of a short-term exposure product. And a great example of futures and how they work is last week when we had this market correction. My account's at all-time highs right now because of futures, because I hedged my portfolio with futures. I took the hit on my portfolio, but I made money with futures when the market crashed, or I don't want to say crash, but when we had the big down move, I was making money with futures contracts against my portfolio. And then when the market rebounded, I took my futures positions off, and it's like the move hardly even happened. But it wouldn't be possible without tools like that you can. And Delta is a good way, is a good tool to use. So like all the major brokers, we constantly talk, or I constantly talk about Delta as a measure of directional bias in the market. But when you beta weight your delta against an index like the SPY or whatever index you want to beta weight it against, it gives you a good idea of your overall portfolio exposure. So then you can turn around and hedge your portfolio very simply with futures products. and you can use your portfolio beta weighted delta to determine how many contracts you need.
I'm starting to feel like I'm in like a sorority rush, delta, theta.
Beta, delta, theta,
Yeah,
alpha,
Kappa,
alpha,
Sigma,
alpha chi,
whatever.
sigma, acacia.
Which sorority do we get into now?
Yeah. But no, it's a great tool.
Sorry,
Futures
lost
are
it.
great tools to use in conjunction with other styles of trading.
Okay, that that is noted. Also, I'm sorry, I have to go because it's getting super late here. It's almost
Yeah.
11. But thank you so
Uh,
much. This was so helpful.
yep.
And thank you,
Absolutely.
Joe and Jonathan Judas, for keeping the conversation going too and asking questions.
Yeah, I had a couple of guys over here as well. They had been adding to the conversation. I appreciate you guys for stopping in, and maybe we'll do this next week, same time ish.
Yes.
Did you know you can put a thing on like the calendar? Like you can set up like an actual calendar so it puts it on your profile the next time you're going live.
Oh, I'll do that. Okay.
Yeah, yeah.
We'll make that note.
Alrighty.
Okay. Thank you.
Talk to you later.
Bye.
Bye.